Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, happy first trading day of a brand new month.
Although the month is not seasonally good for stocks.
That's true, but sell in May didn't work that well either.
True.
So who knows? Let's get to the biggest story right now in the more than $15 trillion global ETF industry. And we start with the U.S. dollar weakening to the lowest level in 2 years as trade tensions return in a big way and also U.S. factory activity contracts.
The SEC raising concerns that proposed crypto funds offering staking exposure may not legally qualify as ETFs.
And we're going to take a look at a high dividend real estate ETF with David Auerbach. He is the CIO of Hoya Capital, who calls real estate the most unloved sector. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. And look, I mean, I'm back again to say it's very bullish in the flows. Todd Sohn, who's in the A block here, he's going to come on and try to do some mental gymnastics that somehow this isn't bullish. But let me show you. The Qs have $4 billion. SPY has $1.3 billion. VGT, that's tech. VU, you got the Vanguard bid. I mean, you got the traders and the retail all at the party right now. Then you got a little gold and a little Bitcoin. Bitcoin there, too, I would put as bullish. And then semis. I mean, again, I don't see how this is bearish, but we'll find out. Let's look at the outflows here. Again, it gets even more bullish when you see money coming out of Bill. That's the cash-like ETF, so putting money to work. IWM, poor small caps. You know, they can't get going even in a rebound. They're left behind once again. And then some money out of TLT. This has been a play on the debt. Is it going to be a problem? I don't know. Money come in and out. Be careful. That is a tough trade. And then some money out of financials. Let's look at Bitcoin, though. I want to focus in on this because really big month for Bitcoin ETFs. All in all, in May, they took in about $5.2 billion. You see, that's a lot of money. They took early part of the year off, and they came back rigorous. But look at this. That's $5.9 billion is IBIT. And then you can see the huge drop-off here, and then negative. So IBIT is over 100% of the net. Everyone else combined is negative. And this is kind of interesting. Normally, IBIT takes in 70% of the flows. My theory is this is an institutional rally in Bitcoin, not as much retail, because IBIT, being the most liquid and having the most options, would attract more of the bigger fish. So, Katie, I think this time, after that decoupling, we're finding bigger investors jumping in even more than retail.
All right, Eric, thank you. And joining our conversation now, as teased, is Todd Sohn. He is an ETF strategist over at Strategas. Todd, great to see you in person.
Likewise, you too.
So tell me why SPY and the Qs taking in more than $4 billion combined last week is not necessarily bullish.
Eric and I are having a good laugh here. This is the best. So I think this is a time frame conundrum, right? Eric's talking about the last week or two. For me, if you look at the flow since the April 8th market low, the largest outflows have come from cyclical sectors and small caps, right? That is not very aggressively bullish. And if you also take an average of all equity ETFs, you're doing about $1.5 billion per day. That's pretty good. But at the start of the year, it was $3 billion a day, which is a very, very aggressive stance. So I look at it as now we're up 18, 19, 20% off the low. There's a meaningful different posture in the way investors are looking at the market than at the start of the year. That's very supportive, I think.
Let's look at just May in particular, because it was a monster month if you look at the S&P 500's returns. But it's not so simple, right? The price action was really, in the first half, it was a sharp rebound. In the second half, we were just kind of meandering. Yeah,
I think coming off of lows, especially in the technical world, when you start to get all these stocks participating, you get overheated. And that is very bullish for the, let's say, the back half of the year. But in the near term, you can get some cooling off, right? Cooling off the overbought condition, cooling off of this run we had since April 8th. That to us is normal. Expect some summer chop. Perhaps some rate agitation leads to some sloppiness in trading, but don't lose picture of the structural trend for equities.
Now, let's go to this. I agree. There was a $1.5 billion a day. It's pretty good. But you're right. It was a little bit less than the robust flows when the market was falling, which were crazy. That said, what if that's a little rebalancing? You know, like when the market was awful, people were rebalancing into the U.S. because it was cheaper. Right. It went up a little bit, some rebalancing out. That's maybe my take on it, or maybe a little bit of the trading crowd taking profits. But how does this set us up for June? People just can't get bullish. I mean, I'm hearing that June's going to be like the worst month ever, and you know, finally we're going to like really take it on the chin. What do you think?
It's a 24/7 news cycle, geopolitical headlines nonstop. We know the passive drip is always going to be there, right? The Vanguard put, as you always like to call it. It's a great phrase. I think my biggest concern, let's just say things kind of go status quo from here, we chop around. My biggest concern would be the return of concentration risk, because you finally had the Mag 7 and the top 10 stocks come off the boil. And those are predominant in all sorts of ETFs, large cap blend, large cap growth. My fear would be a return to that leadership and that kind of addiction to mega cap growth. I don't want to see that. I like when you have industrials and financials leading, as opposed to the stuff we're all kind of watered down in.
Points to a healthier market overall.
Yeah, you want to see participation, right? If you start to get cap weight, some of the large cap ETFs leading while the equal weight ETFs falter, that's a problem for market durability.
Right. Well, we'll have to see how this month shakes out and whether seasonality still applies. It didn't apply last month, maybe June it will. I want to go right into the weeds right now. We're on ETF IQ, so I feel like we can. I want to talk about interval funds, actually. A really interesting trend has developed in 2024, and it's carrying over into 2025, that you're seeing a lot of interval funds come to the market. We're talking about only 25 launches in 2025 year to date, so not huge compared to the ETF world, but still, that's a record for this space. And interval funds, they're kind of the middlemen here. They're kind of like an ETF. They're not quite a mutual fund. You do gate, but it feels like there's a little bit more transparency there, and retail seems to like it. But what do you make of this trend? Why are we seeing so many interval funds launch?
So there's always a habit of issuers to launch something that's hot. Innovation and disruption in 2020, covered calls in 22, concentration in 23, 24. Now we're hitting to intervals because companies aren't going public anymore. So most of the largest companies out there are still private. And I think there's questions about putting those in ETFs, right? The demand has been muted. And the interval fund works. You're providing access to retail investors. Yes, there's a higher fee and there's a hurdle to invest, but it's not millions of dollars here. And you have the gate, the quarterly gate, so you can properly price the fund for the NAV. And you can also put in public securities in case there's a liquidity issue, right, at some point. So I just think it's kind of the right recipe for private assets rather than putting them in open-end fund.
Yeah, I'm not convinced. Remember when Neil Young was telling everybody, you got to use vinyl, you got to use vinyl?
No.
When digital music was taking off? That's what this feels like. Yeah, it might be the perfect way to listen to that album, but it's so much more convenient in an ETF. And when you put private anything in an ETF, what happens is the ETF will just trade like a hybrid closed-end fund. The arbitrage band will stretch a little, but it will still trade. And I think people would rather have that than go into what is a mutual fund, which they associate with high cost and bad outcomes, that has 5-letter tickers. I just don't see it. I almost feel like it's trying to go back in time on this sort of evolution of vehicles.
Yeah, I wonder if they'll have their corner in the record store where the vinyl is, right? Or in the electronics store. But the other question, though, is anytime you're putting really private stuff into this ETF, we have a small sample size now, but the demand has been limited, right? We know about the private credit fund that hasn't had great success. And the ETF with SpaceX in it, had inflows when they changed strategy. Now it's kind of faltering off there. So,
Still, 300 million in that versus Cathie Wood's venture fund, which has 150 million.
Yeah.
That's pretty amazing.
Compare that to Priv, for example, which has been absolute crickets.
My theory on that is credit is just not as interesting. It doesn't really move. It's an inch better. Whereas the private equity is kind of like, oh, SpaceX, cool.
The real question, okay, so there's SpaceX. What's the next big private company, and what fund adds exposure to it? Because SpaceX is there, and you can get SpaceX proxies like Rocket Labs and stuff like that are out there. I'm sure there's some company on the horizon we don't know about yet that will change the world, and there's going to be a rush to put it in whatever ETF is out there.
What's going to be the catalyst that unlocks all that demand, all that interest for these private assets ETFs?
Regulation, proof in the pudding, like Eric talked about. Yes, you've had high yield munis, bank loans, high yield bond ETFs over the course of the years, over the course of history. I think it's just going to be more durability, how these funds act during episodic events, right? Stressful credit type scenarios where, yes, the arbitrage band stretches out, comes back in, and things are okay. I think it's just more on the field usage.
Okay.
All right, Todd, always great to see you. Really appreciate you taking the time and kicking off the new month with us. That is Todd Sohn of Strategas. Now coming up, concerned about crypto. A potentially watershed effort for crypto ETFs is throwing up regulatory doubts from the SEC. That conversation next. This is ETF IQ on Bloomberg. All right, welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with multi-share classes. And this is interesting, I promise, because the SEC, industry watchers say, is getting closer and closer to giving the green light here. And there's a lot of concerns that are starting to percolate here about whether or not that could mean that ETFs start to distribute capital gains. That is famously not what the ETF wrapper does, but a lot of question marks here. We'll continue to watch this story. But let's talk about some interesting filings from last week. Some ETFs that would try to track the portfolios of star investors, including Bill Ackman, Stanley Druckenmiller, Michael Burry, with some income on the side. We'll see if those ETFs actually get to the launching line. But let's end here with the SEC flagging concerns on crypto ETFs. Crypto ETFs specifically that offer staking rewards. The SEC raising concerns that they might not legally qualify as ETFs under federal securities law, Scarlett.
Okay, so there's a lot to unpack here. Let's talk about this issue more with Bloomberg's Isabelle Lee. Isabelle, the SEC sent its letter late Friday, and issuers like Reits Financial, Osprey Funds, they had been planning to launch crypto ETFs that offered the staking exposure. What's the timeline here when we're thinking about, how quickly they were or how far along they were in their process?
So on Friday, we wrote the story that they already received their so-called effective registration, meaning they can file any time. And they actually told us that they will launch anytime. And they actually told us they will debut mid-June, the two ETFs tracking Solana and Ethereum with staking exposure. And then Friday night, the SEC comes out with a letter saying that they improperly filed their registration statement. And then we reached out to their general counsel, Greg Collette, and he said that we think we can satisfy the SEC on their questions, and we don't intend to launch the funds. But on Saturday, it's interesting. We had a really fiery statement from SEC Commissioner Caroline Crenshaw. Eric Balchunas is giggling. She said, how is it that these crypto assets are supposedly not securities and securities at the same time? If you're confused, join the club. I think that was a really strong statement. I
feel like the issuers are getting more emboldened. They're like children who are trying to push the envelope. How much can they get away with? I don't blame them. BitX is an ETF, 2x Bitcoin. It came out 6 months before they approved Spot. It kind of ran the stop sign, and now it's got 2.8 billion. So there's been a couple cases. Priv is another one. So can you really blame these issuers for trying to just get out?
And that's what critics are saying, that it can't be like this. You can't have a piecemeal approach to things and then tackle one issue at a time, because it's tough, And then in Canada, there are actually ETFs with Solana staking. So then some people are also saying that Canada has always been the trailblazer. In reality, not really the US. So if they can make it happen, maybe we can too. So some still hold some optimism around.
So Isabelle, what are people telling you about where this goes from here? I agree with Eric that it does seem like, issuers are pushing the envelopes and in some cases getting rewarded for it. And if an ETF is already trading, it's hard to imagine a world where it comes back.
That is true, but we saw that kind of with Priv. It already listed, and we saw a letter. Priv is the private credit ETF by State Street and Apollo. SEC wrote a letter after. But then the thing with this is, at the heart of it is really whether these crypto assets are a security or a commodity. And I feel like there's still no clarity there, and that's why, to Eric's point, they're just really pushing the envelope, trying hard. And this really wouldn't be possible, according to many people I've spoken to, under an administration that's not Trump.
Right, but we do have a Trump administration that's very pro-crypto at the moment. Talk a little bit about the makeup of the SEC and how that shifts their thinking on this big question of whether crypto assets are security or are not.
The SEC Commissioner Caroline Crenshaw is the lone Democrat there, and she's really the only critic at this point. Or maybe not only, one of the few, let's just say, but it's majority people who are supporting Trump. And I don't think these issuers would be emboldened. I don't think the ETF world will be a Wild West, really, if it wasn't Trump who is in power. So maybe this is a new regime, but it's really interesting because I feel like there should just be clarity. And so this is beyond these two ETFs now. It's a question of how much or how crazy can these ETFs, or how emboldened can they be down the line.
Bloomberg's Isabelle Lee, great story. Thank you so much for joining us. All right, still ahead on ETF IQ, we drill down into real estate and housing with David Auerbach of Hoya Capital next. And just a reminder that you can listen to Eric and Joel Weber on Trillions, their podcast that covers the ETF industry. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we have the Hoya Capital High Yield REIT ETF with the ticker spelled wrong, but on purpose, RIET. And this is simple. It's going after high-yielding REITs. People are already buying REITs for yield. VNQ, I think, yields about 4%. This would be well over double that. So it's like, what are the highest-yielding REITs? That's what it does. It's not active, though, so it uses an index approach, a multi-factor. It's equal-weighted. 50 basis points is the fee, $87 million. Let's look at what it holds. Now, when you go after high-yielding stocks, you tend to get ones that you haven't heard of or aren't as familiar, and that's what you see here. A lot of these are not that familiar to people. Something like Simon would be normally at the top of a bigger REIT ETF. This is going to get you some different kind of companies here. Let's look at the performance of this versus SPY and versus VNQ, which would be like the biggest one in the category. And you can see it's not been great, right? This is about 4 years. It's down 12%. SPY is up 43%, and VNQ is only down 2%. So this one is sort of like a high beta version of VNQ. That said, what goes down sometimes comes up, Katie, and I think 87 million, by the way, with that performance is pretty good. So when it rallies, it could do even better.
All right, Eric, thank you. And joining us now to talk about this ETF is David Auerbach. He is the CIO of Hoya Capital. David, great to have you with us. Let's start with the performance, because I take a look at a total return basis, and your ETF is just a little bit lower on the year, 3.7% or so, but your benchmark is higher. I understand it's not an actively managed ETF, but how do you explain that divergence?
Yeah, Katie, thanks so much for having me. It's great to be with you guys, and it's a very easy answer. Remember that REITs only represent 2.5% of the S&P 500. That differs to like the technology sector, which is over 30%. Another example, office REITs, which only represent 3% of the REIT industry, generate about 80 to 90% of all the headlines and media coverage that's out there. And so if you really peel back the layers of the onion, we see opportunity in the small and mid-cap REITs. If you buy a VNQ, you're buying the largest market cap weighted names that frankly have like the lowest yields that are out there versus the small and mid-cap names that have both the higher beta, potentially the higher dividend yields, and also, by the way, RIET is the only, that I'm aware of, the only REIT ETF on the market that combines both common and preferred stocks. We have a 10% allocation to liquid REIT preferred stocks. So we use this rules-driven approach to try to provide the most diversified portfolio in terms of market cap, geography, sectors, et cetera, to really put out this almost 10% yield that we pay on a monthly basis annualized.
Okay, REITs themselves, real estate investment trusts, make up about 97%, 98% of the fund. Yet, as Eric pointed out, the ticker on your fund is RIET, and that was not accidental. Can you give us the backstory here?
Yeah, it's very simple. I before E because income comes first. When you buy REITs, I don't think of it from, oh my gosh, this isn't putting up NVIDIA-like numbers. I don't buy REITs for stock price appreciation necessarily. You buy REITs for the dividend income stream. The goal of these management teams, frankly, is to keep the blinders on regardless of what's going on in the world of interest rates. How do we maximize our revenue growth, minimize our expense growth, grow our net income or our bottom line to the highest level that we can, and push out the most that we can to shareholders in the form of dividends. So when you look at the income side of the equation, think about these companies that pay monthly dividends as an example, like a Realty Income or an Agree Realty Trust. If you add up those monthly dividends over the course of a year, 3 years, 5 years, 10 years, et cetera, you're talking a serious income stream that flows through to the bottom line.
David, if you look at the flows into REIT ETFs over the years, they tend to be correlated or inverse correlated to rates, right? Because if you can't get a lot out of like a short-term treasury bill, right now you can get almost 5%. Well, REITs yield a lot, so you're going to go out to find yield. Now you can get that much in really low-risk treasuries. So do you need rates to fall for this category to really blossom, including this ETF, or can you make it even if they hang around 4 or 5%?
It's a great question. We could spend 30 minutes alone on that. You know, REITs somewhat are interest rate sensitive. I've always said 4% is the magic number. If a 10-year treasury goes below 4%, that's great for REITs, and it really corresponds to the dividend yield. If you market cap weight the dividend yields across the sector, it's about 4%. If you equal cap weight those yields, it really goes to like 6.5% or so. And so really on a risk-adjusted basis, that's why we see this value again in the small and mid-cap names. But right now, with REITs trading around the 4.5% level, you know, REITs are the punching bag that's out there. And I think it leads to that 45% underperformance versus the S&P. If you look at the Bank of America Advisor Survey recently, REITs are basically the most unloved sector that's out there. And if should the Fed cut rates, you know, you want to be ahead of that curve. You don't want to do that trade after the Fed cuts rates. And again, with them only being a 2.5% exposure in the S&P, you know, it really is almost like I don't want to say it's a no-brainer, but, you know, there really is no cost in being wrong because it's such a de minimis part of that index.
Well, I want to talk about that a little bit more, that in your view, this is the most underloved sector. I hear what you're saying, that you want to be ahead of the curve. You want to get in before the Fed cuts interest rates. But when it comes to socializing this area to the broader investment public, is that what it's going to take in your view? Is it going to take the Fed actually finally lowering interest rates in a meaningful way?
Well, you know, it's funny because I kind of sit there every single day and say, look, we use REIT-owned properties every single day, not thinking about what's going on with the world of the Fed or the 10-year Treasury. As an example, we're utilizing a data center REIT to facilitate this conversation today. You order an Amazon package, you use 3 different REIT sectors to get that package to your doorstep. We use REIT-owned properties every single day of our lives. Obviously, from the headlines perspective, from the business network's perspective, to the advisors and the investors, if the Fed does cut rates, then it should bode well for REITs. But for these management teams, they've been operating in this environment, this high for long environment, for several years now. The debt markets are wide open. Those REITs that are well capitalized have raised tens of billions of dollars of new debt in the past few months.
Right.
And so it's business as usual for a lot of these guys. Frankly, REITs are the most tariff resistant of a lot of all those sectors that are out there, since the majority of those revenues that are earned are all domestic based.
Right.
And so really, we think this is an opportunity.
All right, David, got to leave it there. Great to get some time with you. That is David Auerbach of Hoya Capital. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.